2017, we saw new venture disruptors, the $100 billion fund by SoftBank. In Asia, we have the BATs, who have been very active in investing. In the US, we have the FANGs, who have also been very active in pursuing startups there. And then, of course, we can't go through 2017 without mentioning ICOs and what it's done to early stage investing, or at least for now. So I'd like to invite up to the stage Gavin Locke and Alokik Advani to join me, and we're going to have a conversation about what do investors really look for in early stage investing, and then we'll get to how do they feel about the BATs, the FANGs, SoftBank, and ICOs and the impact on their markets. So just to start with, Gavin and Alokik, why don't you take just a couple of minutes to introduce yourself and what the firm does?
Yeah, thanks, Melissa. Can you hear me?
Yeah. You're on now.
Hi, everyone. I'm Gavin Locke, the COO of Senjo Group. We're a gold sponsor here for the second year running at FF18, and it's great to see the room so busy. Senjo is a privately held Singaporean-based investment business. We look at FinTech investments in a fairly broad way, but we've got a focus particularly around payments and lending. And outside of that, we also look at early stage investments, seed, Series A, Series B.
Hi, I'm Alokik Advani. I manage the Principal Strategic Investments team at Goldman Sachs. We are focused on early stage investments into FinTech companies where we think we have a strategic use case or a partnership opportunity to work with those companies. We're actively involved across all the different verticals of FinTech. We do not have a fund structure. We use our own balance sheet to make investments, and we have about 80 companies globally and have been doing this for over 15 years.
So I just want to start out with a basic question. You know, what's going to be different in 2018 versus 2017? But then we'll get to some more of the interesting aspects. But Gavin, what do you see as different going forward in 18 and 19 compared to the market we've been in 16 and 17?
Yeah, look, certainly, from my perspective in looking for investments, I'm looking to identify those companies that are actually hitting their growth curves. I mean, it's a fairly new ecosystem, the whole idea of FinTech. And 2 or 3 years ago, we were seeing a lot of early stage businesses with predicting J curves of growth, profitability.
But venture guys always want the J curve of growth.
Yeah, look, I think whenever we sometimes call it in our in Senjo the Viagra curve, and I just don't believe it. I'm a natural pessimist, so what I'm really looking for now is those companies coming back looking for next rounds of funding that have achieved what they said they were going to achieve in the last couple of years, and they're on that curve to deliver real revenues and real profits, and they have something meaningful about their business. I think that's particularly what I'm looking for the next couple of years, going through that maturity curve.
Alokik?
I mean, I think for us, it's twofold. I think the first one is there's been a maturation across what we're seeing as some of the startups, which are largely focused initially on retail, payments, remittance, some of those spaces, which now you're seeing people get into the institutional space, which is kind of where we play. And also, I think you're seeing people focus really on value, not just hope and dreams. So people coming out and saying, are these companies actually going to be profitable? Are they going to make money? And it's not just forward funding rounds one after the other.
And to that point, I mean, what are you looking for when you get into the due diligence process? Is it really about the market, or are you really focused on the team?
I think the first one for sure is the team, because that's the one that's going to deliver. Oftentimes when you're doing early stage, the team is most important, because they will pivot the product, they will likely change the market focus that they'll go after, but realistically you're going to have to find someone who you can trust, who you can work with, because you're going to get the calls in the middle of the night, you're going to be babysitting them on the weekends, and you're going to be truly working with them, hand to hand for a long time. So you really want to find people who you can resonate with, understand the product, the market, the fit, their personalities, and how they're going to deal with all of that as well.
And Gavin, how about you? What does the firm look for?
Yeah, I think absolutely buying into the team that's going to drive the business. I think those soft relationships between a business and its investor are so important. And I think it's only through trust and joint hard work that you're going to find the right investor, and I think that goes both ways. So we're looking for a great team that's going to deliver, and I think also as people looking for investments or startups looking for investments, you need to find the right personalities on the other side in terms of your investors. So it's a two-way thing. I think you need to click, you need to have trust in one another, and you need to make sure that you're both got something to bring to the table and offer.
Well, I think at Arbor Ventures, I'll just elaborate, we believe very deeply in teams, but it's not necessarily that we look for CEOs that we want to invite to grandma's house for dinner or to a cocktail party. We actually believe that the CEO makeup of very successful startups is quite different than the average person. And so we've done a lot of testing around what's called the Black Triad personality test, you know, whether they're Machiavellian, a little bit psychopath, a little narcissistic. Because if you look at the greatest CEOs of startups, Steve Jobs, Elon Musk, you know, the list goes on. They all have this grit and perseverance that goes beyond anything that most people can comprehend or are willing to put themselves out there for. But, you know, I think for us at Arbor, when we look at startups, it's really about the CEO, their characteristics. Can they raise money? Can they build a team culture? Can they stick with it when things are going wrong? Can they be introspective enough to take a 360-degree view and actually change and pivot as you go along? And I think, you know, maybe you guys are slightly later in the investment stage, but when you're going in first money, I think these attributes are extremely important. So I think, you know, next question is then, you know, how do you deal with, you know, startups when they're coming into the office? I'd love to get, you know, what are the top 3 questions that you ask them that sort of make a no or go, you know, no go to the next level? Gavin, you want to take that?
Yeah, I think for me, the thing that I look for from teams coming in and pitching is a really true understanding of the economics of their business, how they're really going to make money, not just revenue, but profit, and be to really understand what are the drivers of their business that's going to get them there. So I think, yes, doing something different or doing something better in the marketplace, you know, the idea and the quality of the idea, but really a very clear, realistic plan about how the economics of that business are going to work over time and their path to profitability. Always, for me, path to profitability and having a very clear story about how that's going to happen. And also a very clear sort of requirement of me and my business and how we're going to help them on that journey. So, you know, making sure that, you know, that there's clarity of expectations, very clear milestones, and that we're all going to work together to go and deliver it.
I mean, I think just to add to that, as a strategic investor, we're slightly different from that point, right? When we have people come in, the first point I'm thinking about is not how much money we can make from this. We're thinking about, can we use it? Can the tech work for us? Does it make sense? Is it tied to some version of all the different businesses that we have internally? So the first piece there is, can that person articulate the story of what they're doing, how it applies to us, and how it could work for us? So I think that piece is first, because you know, the premise that we always work with is you can get cash from a lot of people. There's a lot of VCs out there. There's a lot of family offices, a lot of, you know, high net worth individuals. We're bringing you capital plus the brand plus ourselves potentially as a client, which frankly for most early stage companies is more valuable than the cash. So.
And so as you're looking at the stage at which they can engage with you, you know, at Goldman Sachs, I mean, what is sort of go, no-go, or you can be extremely early and really help them along? I think it's important for the audience, especially for those startups who want to come talk to you. I mean, really, when should they approach Goldman, or when is it just simply too early?
I mean, I think the hard part is, you know, we invest in companies that already have revenues, so we don't come in seed or angel side. Usually our check sizes on average range from about 5 to 15 million, so 5 million minimum. So and we don't need to do a whole round or be significant majorities. So that would be a Series A timeframe. But more interestingly is companies that want to see us come and tell us why your products are useful to us and research which part of the business it fits in. If you just come and say, hello, you're Goldman Sachs and you can use this thing, and you start talking about a bunch of payments products, that's great, but we don't have a payments business. So you need to understand where the fit happens, how it works, and what it does.
And Gavin, for you, it sounds like you guys are also a little bit later, given the fact that you want to see the road to profitability. What stage and what size?
I think it depends on the sector that we're investing in. So certainly in payments, which is the largest part of our portfolio at the moment, then we do look for later stage businesses that have got real revenues and either are profitable or very close to profitability. Certainly on the EBITDA line and hopefully on the cash line. So payments, we're looking for a little bit more maturity, primarily because in that scenario, we're very much a strategic investor. So we're looking to leverage our assets that exist in Europe and see how they can benefit and accelerate businesses here in Asia. So that's payments, which is a slightly different way of investing. And then certainly on in things like sort of lending and the wider FinTech ecosystem opportunities that we see, we actually are investing a little bit earlier, some seed, some Series A as well. So if profitability is not close, that's okay, but just a very clear story about how and why you're going to get there that's realistic, that's for the founders and for the management team to demonstrate to us how they're going to execute. That's really important. So it might not be profitability in the next 6 months, but a very realistic plan of how you're going to execute and get there.
It's so difficult, though, today. I mean, how do you determine what a payments company is? I mean, let's take a Gojek as an example, right? Indonesia had quite a few good startups. They had Doku, they had Veritrans, and then all of a sudden what we thought was just a transportation copycat, not even in cars, but motorbikes, now turns into the most important payments company in Indonesia. So in some regards, it's challenging for early stage investors especially, or for any venture investor to really figure out what is a payments company, right? What can this company become? And I think in some regards that has, that has been the challenge that today the worlds are becoming blurred. I think, as the Visa video showed it early on, e-commerce, your everyday lives, your everyday existence is all becoming digital and actually intertwined. And so I think it makes it a lot more challenging to figure out what nugget's going to be able to scale. And actually, for Alokik, it's quite different because it's got to be strategic. But I think for early stage investors like ourselves and you, Gavin, I think it's quite challenging environment from that perspective. So I think another question is also for the audience, especially for the startups here, how long do you expect to hold an investment?
Oh, great question. Look, I think we don't have a set playbook by which we want to get a return on investment from a time perspective. Certainly, we have a strategy in place with our payments investments that we have an aspiration to have an exit event in the next 4 to 5 years. So hopefully that will be something more meaningful than we've got today, and we've got an awful lot of hard work to do to get there. But in terms of the other type of investment we make around the FinTech piece, I think that's a conversation that needs to be had between the investor and the company, which is what are your exit plans? Are they aligned with the investor and the founder? And so I think so it's a little bit of chicken and egg in terms of what's our desired exit time. I think alignment and with the founders is important in answering that.
Don't laugh, Alokik, but the minute somebody comes in and it's a Series A and they say Goldman Sachs is going to take us public, they never get another meeting with us because clearly they're unrealistic about their timing and expectation.
Absolutely. I mean, we do the same thing as well. So I think for us, the time frames are slightly different, right? Because again, we're using our own money, we don't have a fund structure, and the strategic element, there's some times where we fulfill that strategic purpose or benefit within a couple of years. Sometimes it may take longer. Sometimes it's so core to the existing franchise that we may want to hold this for much, much longer. So I'd say on average, we do sort of 3 to 5 years, but there are times when we'll hold something for 20, and there'll be times when we may get out of something in 1 or 2. So, but the core is really that 3 to 5 time frame.
So I want to get back to, again, when a startup comes into the office, and really they have to hold our attention in the first couple of minutes because most people understand that most venture capitalists have ADD, so if you don't capture their attention in the first couple of minutes, you're going to lose them. What does it take in that first 3 or 5 minutes, Gavin, when they walk in your office and say, we're so-and-so that grabs your attention? What is it?
Look, I think it's passion. I think it's clarity on what that initial idea is. What's unique, different? What are they going to do different to their competitors?
Is it okay to have competitors? I mean, that's always a question. So if somebody comes into your office and said, we have no competitors, is that a good thing or is that a bad thing?
A very bad thing from my perspective because it's complete baloney. It's just not true. So I think a realistic position of where you are in the marketplace, where the market is going, and how you're going to beat competition and differentiate yourself, absolutely critical. And just on a very practical point, if a business comes into our office and starts to fire up the PowerPoint and starts to read off slides, gone immediately. Even, my mind is turned off immediately because you think that that's a sign for me that, a lack of passion, a lack of clarity on what your business does. I'd much rather have a conversation with somebody over half an hour rather than trawl through slides. And then, have information to back it up, critical information that your investor is going to ask you about. But certainly, don't walk me through a slide deck.
Alokik, how about for you?
I mean, I think it's the same thing with what Gavin mentioned. You want someone to come in with the passion, be really articulate about their message. I think for me, what also helps is if they can show examples of proof of concepts, demonstrate how people are using them, where they're using them. So it seems more real than this is a theory, we'll build it and they'll come. That's not always working, especially in our end of the scale, which is an institutional market space where your sales cycle is going to be so long that you've run out of cash long before your client comes through the door.
Yeah, absolutely. Sales cycles are really important. If it's B2B and showing 3-month sales cycles, they obviously don't really understand that 3 months is going to look more like 18 months or 24 months. Completely agree. And then the running out of cash. Just turning the attention, though, even for entrepreneurs in the room, when companies do run into hurdles and stumbling blocks, which inevitably they all do, how do you handle it, Gavin? I mean, what is that conversation like? And what advice would you give to the startups in the room as to how to interact with their investor in that case?
Yeah, I think that's a great question. I think for me, no surprises. So if it comes as a surprise, I'm going to react differently to if I've been engaged all the way through and, and seen a problem develop. So being involved early in sort of, negative trends in the business, if you want to sort of classify like that, I think is important between the company and the investor. So being part of that journey, being involved in the decision, having the ability to, potentially influence it rather than being, the ambulance at the bottom of the cliff when the issue has, become quite serious. So being involved, and then that way I can, help.
I mean, I think it's absolutely on that point. It's transparency, right? You want to have, you're on the side of the business, right? You're an investor, you're either sitting on the board, you're engaged with them on a regular basis, you're hopefully seeing their financials, you're understanding their story. You want to be told when things are going wrong before it's the end of the world, right? And so, or if they're running out of cash, you want to be told when there's 3 months of life, not 3 weeks of life or 3 days of life, right?
We prefer actually 9 months of life.
Exactly. So I think that transparency is hugely important, and having that trust element be very clear where the company's management understands the role you play, and they're not seeing you as the adversary, they're seeing you as somebody who comes in and can help, right? Because you can potentially help with bridge financing, you can potentially help with your own Rolodex, you can help with connecting to new investors, clients, new management, hires, people, all of that. So that's the role that we play on the post basis. Besides trying to make sure that our strategic use case works, we're also playing the role of helping the company, right, on their vision, their strategy, their team, their product development, et cetera, all of which is hugely important. We want to make sure that that doesn't only happen in good times, but it happens when things are going wrong as well. And so we can be there along the entire journey.
So I think the advice for the audience is if you're a startup in the room, don't treat your investors like they're some foreign disease, but actually you should really engage with them and have, a good conversation. And when you are running into stumbling blocks or product market fit, it's much better to come forward and work alongside of them rather than just try to put Band-Aids on it and hope the problem goes away, which inevitably it never does. So I think that's, excellent advice for the startups that are in the room. Just want to turn back to sectors. We'll start with you, Alokik. What do you find are really the most intriguing sectors right now for investment in FinTech?
Yeah, so there's a few different themes we've been looking at for a while, and those have sort of kind of stayed. Some have evolved a bit, but the entire data play going from data analytics through machine learning through AI is very relevant to us. We see large swaths of data going through our pipes every day, whether it's trade data, it's communications data, et cetera. If we can make sense of that, we can serve our clients much, much better. So that entire exercise around trying to optimize the data sets that you have to a better outcome is very, very beneficial for us. The second part is we've been hit with an obscene amount of regulation, the most recent one being MiFID II. And so if we're able to have technology that can help us address some of these problems, there's huge value to it. I mean, the armies of people that we had to deal with MiFID II was just astounding. So the tech that can help us get there is very valuable. coming down, I don't think we can go through a panel without mentioning the word blockchain and crypto over the course of this week. So blockchain, very relevant. We all have inefficient processes that we have, whether it's in the middle back office or sort of the operational flows. Anything that can help us there is helpful. I think the crypto space is really interesting. I mean, you've seen the sort of the creation of a brand new asset class after a long, long time, and people have sort of compared it to your tulip bubbles and your other asset bubbles from the old days. And I think while that is relevant, what it has done here is shown that there is demand for investing into a new asset class. But the fundamental issues that we see there are issues in the market structure that exists. As market structure investors, we're thinking through at a very, very early days, what does this mean? What does this look like? Can there be a safer, more efficient ecosystem across the entire spectrum, from the exchange universe to the custody settlement universe to the KYC piece, all across the board?
So do you see regulatory arbitrage then coming? Because if you think about China, Vietnam, South Korea, Indonesia banning crypto and ICOs, and yet one of the most change-resistant economies in the world, Japan, not only endorses ICOs and cryptocurrencies, but they actually now have launched the Cryptocurrency Girls, which is a new pop band.
Absolutely.
So, is that evidence that we're going to see regulatory arbitrage going forward in the crypto space?
I don't think it'll be reg arbitrage. I think the economies where they saw it as flight of capital have been much more constraining. Mm-hmm. So China is a classic example. I think they've gone the entire whole hog of saying not only are ICOs bad, but trading a crypto is bad, mining is bad, and everything else along the way. So Japan's been quite interesting. I think Japan in general has been somewhat forward-thinking in the electronification of some of the markets. So I think that role that they've played here, potentially, I mean, I don't know this, I'm just guessing, but I think they've almost come on this where they wanted to help FinTech evolution sort of progress. And they've gone to be the only market in the world that's now licensing, crypto exchanges. So it's kind of gone the entire extreme, and also a large portion of the volume of the tokens comes out of Japan. So I think we're not done with the regulation yet. You're going to see a lot more of it in that space. I think every single market regulator is looking at it, not just on the ICOs, which is raising money from individuals and retail, but also on every aspect of it. I mean, the most recent blow up on CoinCheck is another one where you're seeing people be able to hack it and steal the tokens without, much effort, or, without a lot of controls in place. And so I think that the concept around custody and who's holding it, how's it holding it, what's hot, what's cold, where's that storage, who's able to hack it, is going to become much, much more relevant. And I feel that the regulation around ensuring that you've got sensible custody is going to be very, very relevant.
Yeah, completely agree. Gavin, what do you see as exciting for 2018?
Well, I think that whole crypto piece, it's exciting from an investment perspective in terms of businesses, mining currencies and offering them via exchanges. But from our side, it's also playing a role in the payments value chain. So, I think, we'll see more over the next 12, 24 months, some more use cases in and around payments and cryptocurrencies. I think it's searching for an avenue to be spent, and I think we'll see more of those sort of merchant type scenarios accepting crypto in a more mainstream kind of way. But again, it comes with risks. From a payment regulation perspective, crypto's actually quite dangerous. It's got an awful lot of controls about how much you can trade, your frequency, your velocity, and that doesn't necessarily align with those people that are looking to try and spend it in legitimate ways.
Well, I think as we saw, the dog coin, which started out as somewhat of a joke, is now worth $1 billion. And actually, people were able to send the Jamaican bobsled team to the Sochi Olympics using it. And they've actually sponsored a NASCAR race car team. So, you just never know. But I do think once you solve the custody issue, we're going to see more and more adoption probably of cryptocurrencies. It will be interesting to see what happens with the governments and regulation and how they deal with the flight of capital. Perhaps Bitcoin or cryptocurrencies, after all, are starting to nibble at the power of the monetary authorities globally. They don't like it, but maybe it is an inevitable trend. So just to finish up before we ask for questions so how do you feel about the BATs, the FANGs, SoftBank's large fund, and the disruption in the industry?
Yeah, look, I see it in my world. We see an awful lot of, how can I say this nicely, lazy cash coming in and, competing for investments that we would like to look at, but looking at it in a completely different way. And obviously valuations are very high at the moment regionally, particularly for payments. It's got a lot of attention on it. So, we see a lot of, Japanese and Korean money being present here in Asia and not necessarily going through the rigor of due diligence that a smaller business like we would do, but then, happy to deploy cash at very high multiples. So, I see it, in competing for investments and, and probably somewhat irrational versus where we would look.
I mean, I think I see the three very separately. I think starting with the first, I think the SoftBank Vision Fund, the size and scale of it has allowed much more mature companies that are still privately held to stay private longer. They don't need to go into an IPO market. They can stay within their private universe and scale. And that gives them various autonomy to operate into different things. I think on the FANG side, the interesting part is you're trying to see them evolve cross their little silo that they originally played, or their big silo that they originally played in. Many of them are expanding into financial services or trying to expand into financial services. You're seeing that across Amazon with lending. You're seeing that across Facebook with WhatsApp and some of the payments pieces coming through there as well. I think, and so you contrast that with the bad space where most of them are already in financial services in different forms, right? I mean, with whether you talk about Alipay, WeChat Pay, Ping An, and the Baidu crowd. So they're all at different stages. I almost feel the behemoths in China are much further along in their financial technology evolution than the similar companies that have dominated the markets in the US, which are still scratching the surface, and a large part of that is driven by regulation. Yeah. The regulation in the US curtails what they can do, and it's allowing them to kind of just dip their toe. Whereas in China, they were given a lot more autonomy to jump headfirst into some of these financial areas, whether it was payments, it was lending, it was remittance, and the like. And that's allowed them to create what, China by far is the leader in the world in terms of, FinTech evolution getting to the mass market.
Yeah, absolutely. I think the bats have used it more for geographical expansion in different markets, right, where in the US, they are just trying to expand out of their verticals that they grew up in. So
I think therein lies some of the challenges for those guys as well, locally, dealing with local regulation, some regulators preventing, those Chinese alternative payment methods from operating in those countries. So, yeah, done a great job in China. Can it be exported? Probably still a question mark.
I bet on it. But let's see.
Me too, to be honest. I think it'll be overcome. But
great. Well, let's take some questions from the audience. We just have a couple of minutes left. Any questions? Somebody's waving a flashlight or a light. We need a mic, please.
Yeah, it's a question for Melissa. My name's Elliot Hall from a company called Zapago. You seem to know a lot about ICO and cryptocurrencies. I know you can't give advice, but what's your opinion on doing an ICO out of Gibraltar? We're just in the middle of that now.
Well, we wouldn't be doing the follow-on financing.
Yeah. And not at all if companies doing ICOs?
We don't invest in ICOs or companies doing ICOs.
Yeah.
If our companies we already have invested in choose to do an ICO and raise money and it's non-dilutive to us, God bless them, yeah, but we don't invest in companies that have done an ICO and we don't buy ICOs.
Yeah, that's fantastic. Thank you. I wasn't asking for investment, just your opinion. Thank you. Bye.
I'm curious as to if there's any sort of statistical evidence that VCs are better than anybody else at actually picking the winners. I mean, startups come to VCs because VCs have the money, but essentially the VCs are just betting on horses and some of them come in. So in the future, if the ICO marketplace makes it easy for the startups to raise the capital in that direction, the VCs then have a different kind of business, which isn't about the money. It's more about the nurturing and the connections. And so do you see new kinds of VCs springing up in that kind of area? Or do you feel that the VC business really is just going to ultimately just wilt away?
The VC business has been under attack, especially early stage, for many years. We had Kickstarter, we had AngelList, we had super angels, we've had ICOs. Fundamentally, what venture capitalists really do is not about the money. It's about just a distinguished brand with a strategic network. And when you access a venture capitalist, whether it's one of the top brands or not, you should be getting access to a strategic network. You should be getting mentoring. You should be getting access to their Rolodex, and you should be. And there's proven empirical evidence that the value of the network can actually determines the venture returns from venture capitalists. So we've always been under attack, but it's not we just hand out money. It's actually far more scientific to that, which is there's a certain characteristic and element of how markets develop and how certain entrepreneurs can determine product market fit. And then you couple that with the venture, money is the least important element of what a VC brings to the table, but you couple that with mentoring, advice, Rolodex, and strategic access. That makes for a winning formula. Now, if you have venture money that's coming in and it's lazy and it's just there to provide capital, sure. Why not take an ICO? It's non-dilutive. But you also don't get any corporate governance whatsoever. Anyone else?
No, I think the word ICO is being used very loosely and very broadly here, right? You have a range of different tokens that you can have, and many of the regulators are focusing on a security token that gives you almost equity-like rights versus something that's a utility token that's more for use of a product or a service. So I think that's where you might see companies going in the forward, where they might tokenize something, but which looks like more of a security. But I think the way it is, I think the statistics that you're looking for may take a little bit more time because you haven't seen the full wave of the range of the 1,500 or so tokens play out to understand where there may be potential misrepresentation, potential fraud, or potential negligence on some of the companies. So.
Well, we're just starting to see that. I mean, just starting to see where the governments are cracking down on whether it's actually a utility token or actually a security.
Right.
And I agree. I think it's so early that probably 3 years from now you'll see the statistics, or maybe even longer. Great. Time's up. Thank you very much to our panelists and for a great audience. Thank you.